The India-US trade deal announced on 2nd February is unlikely to trigger an immediate shift from Russian crude imports, with market analysts predicting that any changes in sourcing will be gradual and driven by commercial considerations rather than political commitments. Hello, I'm Udit Bubna, and today I will discuss how India-US deal may not result in immediate shift from Russian oil. Despite US President Donald Trump post on Truth Social this week that India would stop purchasing Russian oil and increase purchases from the US and Venezuela, energy analysts say Russian barrels remain economically critical for India's refining system. Sumit Ritolia, lead analyst for refining and modeling at global trade intelligence firm Kepler, told ThePrint, and I quote, Russian volumes remain largely locked in for the next 8-10 weeks and continue to be economically critical for India's complex refining system, supported by deep discounts on Urals relative to ICE Brent. Ritolia expects Russian imports to India to remain broadly stable in the 1.1 to 1.3 million barrels per day range through the first quarter, that is January to March, and early second quarter, which is April to June of 2026, meaning the trade deal may not immediately translate into lower Russian intake. Kepler data showed that in January 2026, India imported around 1.16 million barrels per day from Russia, accounting for about 22% of total imports for the month and the highest for any country in the time frame. Russia was followed by Iraq at 20%, Saudi Arabia at 15%, United Arab Emirates at 8%, and United States at 6%. Instead of a sudden cut in Russian oil, Ritolia of Kepler expects India's diversification to continue gradually, with US emerging as the primary marginal winner. According to him, US crude could rise to nearly 10% of India's monthly intake but would largely displace lighter Western African barrels rather than Russian supply. Prashant Vashisht, Senior Vice President and Co-Group Head for Corporate Ratings at ICRA Limited, said India could buy more crude from the US but commercial viability will dictate decisions. He emphasized that Indian refiners will weigh pricing and margins carefully before shifting sourcing patterns. Vashisht said, and I quote, it may not naturally follow that just because somebody has announced, Indian refiners will go and buy. A key challenge, he said, is freight cost. Vashisht estimated that shipping crude from the US Gulf Coast of Venezuela to India cost about $2.5, going up to $4 per barrel, compared to Middle Eastern crude, where freight can be just between 40 cents to 70 cents per barrel. Alongside the US, Venezuela has also re-entered the conversation as a potential supplier, particularly for Indian refiners capable of processing heavy grades. According to Vashisht, Venezuelan crude is very heavy and sour, meaning very few refiners globally can process it. Indian refiners like Reliance Industries are better positioned to refine Venezuelan oil than other global peers. Venezuelan crude oil imports have not shown any uptick recently, with last shipment dating to May 2025, largely by Reliance Industries. But recently, Reliance Industries had made a deal to purchase 2 million barrels of oil from Venezuela, according to a Reuters report, though no timelines have been mentioned. Over the long term, Vashisht pointed out that the economics of Venezuelan oil would remain challenging because of distance. He stressed that Venezuelan crude would need to be priced much lower to offset shipping costs. He said, and I quote, Venezuelan crude has to be available at significantly lower prices to be able to justify the freight cost. Another limitation, according to Vashisht, is that Venezuelan production is only about 900,000 barrels per day, and scaling output would require very large substantial investment which could take years. This highlights that Venezuelan oil cannot meaningfully replace Russia in the near term, even if sanctions ease. Ritolia of Kepler similarly argued that Venezuelan crude offers optional, non-structural upside for India, but it is constrained by weaker economics, sanctions compliance, insurance, and blending requirements. Going forward, Russian oil is moderating, but will not retreat from India's import basket. Since US sanctions kicked on 21st November 2025, there has been a decline in Russian imports. Kepler data showed Russian crude imports to India in January 2026 fell 37% from November 2025, when the sanctions kicked in. According to Ritolia, this marked India's lowest Russian crude intake since late 2022. However, this decline is a short-term procurement adjustment rather than a structural shift from Russian barrels. Last month, Reliance Industries avoided Russian cargoes, along with some other refiners, after European Union sanctions came into effect on 21st January. But Russian crude has not disappeared from the region. It has simply been held offshore. Kepler data showed that more than 30 million barrels of Russian crude were floating in tankers in the Arabian Sea in January, more than 20 million barrels remaining in floating storage in the region. For comparison, last year in January, floating storage was less than 10 million barrels. According to Ritolia, while some of these cargoes could move to China, the majority are expected to find home in India once commercial and compliance considerations are resolved. For Indian refiners, Russian barrels remain hard to replace at scale because of pricing. Ritolia noted that Russian Urals continue to trade at deep discount relative to Brent, making it economically critical for India's refining system. He said any sharper reduction would require a clear policy shift by the Indian government, which appears unlikely given energy security concerns. Thank you for watching. For more such videos, please subscribe to the Print's YouTube channel.